You are offered a choice between two games. In Game A, you have an 80% chance to win $100. In Game B, you have a 20% chance to win $500. You can only play once. Which do you choose? Your answer reveals whether you think like a gambler or a quant. By the end of this video, you won't just know the right answer, you'll understand the single most important concept in all of quantitative finance. If you're like most people, you probably lean towards Game A, and it makes perfect sense. An 80% chance of winning feels good. It feels safe. It's the bird in the hand choice, and there is nothing wrong with that. The reason this choice feels so right is rooted in psychology. Our brains are wired with powerful cognitive biases, and one of the strongest is called loss aversion. Decades of research have shown that for most of us, the pain of losing a certain amount of money feels twice as bad as the pleasure of gaining that exact same amount. Your brain isn't just seeing an 80% chance to win, it's desperately trying to avoid that 20% chance of feeling the pain of getting nothing. There's also another force at play, the fear of future regret. We are constantly trying to protect our future selves from feeling foolish. If you choose the risky game B and lose, you'll spend the rest of the day thinking, I could have had an easy $100. The human brain will almost always choose the path that minimizes potential regret. This is the human choice. But it is not the quant's choice. A quant has learned to ignore these feelings. They ask a different, more powerful question. What if I could play this game 1,000 times? Which one makes me wealthier in the long run? To answer that, they use their most fundamental tool. That tool is called expected value. It sounds complicated, but it's an incredibly simple and elegant idea. Expected value is just a way to calculate the average outcome of a single event if you could repeat it over and over again. It gives you a single number to compare different bets, stripping away all emotion and bias. The formula is straightforward. You take the probability of winning and multiply it by how much you win. Then you add that to the probability of losing, multiplied by how much you lose. Let's put the formula for a moment aside and let's change the rules of Outgame a bit so that we can understand the concept better. Let's imagine that for Game A, we have an 80% probability of winning $30 and a 20% probability of losing $100. And for Game B, we have 1% change of making $10,400 and we have 99% chance of losing $100. Now let's calculate the expected value for both games. For Game A, the expected value is 0.8 times 30 plus 0.2 times negative 100 equals $4. For Game B, the expected value is 0.01 times 10,400 plus 0.99 times negative 100 equals $5. And there it is. The math is clear. Game B, the one that feels riskier and that you will lose 99% of the time, is the mathematically superior choice. On average, it's worth $1 more per play. The quant plays Game B every single time. But seeing it on paper isn't enough. Let's prove it.
To put this to the test, let's run a simulation. We'll have two players, one for Game A and one for Game B, each starting with a $100,000 bankroll. We're going to have them play their game 1,000,000 times. Now, to keep this example simple, we'll assume neither player can go bankrupt. Even if their bankroll dips into the negative, they can keep playing. In the real world, of course, you can go bankrupt. Preventing that involves a crucial topic called bankroll management, which is the science of sizing your bets to avoid ruin. If you'd like a deep dive on that, let me know in the comments below. Finally, we'll plot both players' bankrolls on a graph to see how their wealth changes over those million plays.
Let's start with Game A. As you can see, Game A's journey is very comfortable. It's a smooth, predictable climb. The wins are frequent and the losses are rare. It's low stress. At the end of the simulation, his bankroll has grown substantially. This looks like a great strategy, right? Now let's watch Game B. Game B's journey is completely different. It's psychologically brutal. Look at these long losing money streaks. He's making losing a lot of money, feeling like his strategy is broken, all while he can see player A getting richer and richer. He's losing most of his bets. This is the pain of a high volatility, positive EV strategy. It requires immense discipline to stick with it, but over the long run, the math is undeniable. Despite the gut-wrenching volatility and the frequent losses, Game B's superior mathematical edge, his higher expected value, inevitably takes over. He accepted short-term psychological pain for a much greater long-term financial reward. This is the very essence of thinking like a quant. This principle isn't just theoretical, it's the foundation of entire industries. Think about a casino. On any given hand of blackjack, the casino might lose. On any spin of the roulette wheel, it might lose. But they don't care about any single outcome. Every single rule, every payout, every card in the deck has been meticulously calculated to give the house a tiny, persistent, positive expected value. That tiny edge, often less than a single percent, is their signal. Multiplied by millions of hands played every single day, the law of large numbers at work, that fractional edge builds multi-billion-dollar empires. They are playing Game B on a colossal scale. It's the same logic for an insurance company. When you buy car insurance, you're making a bet with the insurer. They are betting you won't crash, and you are betting you might. They collect your monthly premium, a small, certain gain, and in return, they accept the small probability of a huge loss if you file a claim. As long as the premiums they collect from everyone are greater than the expected payout for claims, their business model has a positive EV, and they profit. And this brings us directly back to the world of quantitative finance. The most sophisticated hedge funds in the world operate on this exact principle. A high-frequency trading firm might make millions of automated trades a day. Many of those trades will be tiny losers, but they have designed a complex system where their average trade has a fractional, positive expected value. Their entire business is a real-life version of our simulation, running at the speed of light, exploiting tiny mathematical edges that are invisible to the average human investor. So, the first rule of the quant street is this: stop trying to be right on every single play and start thinking in averages. A single outcome is just noise. The mathematical edge, the positive expected value, is the signal. That is the fundamental shift in mindset from a gambler to a quant. So to recap, your gut will lie to you, driven by biases like loss aversion and regret. Expected value is the tool that cuts through that noise. And finding a consistent strategy with a positive expected value is the only game a quant is interested in playing, no matter how risky it might feel in the short term. But this raises a critical question. In our simulation, player B's journey was incredibly volatile. What if he ran out of money during one of those long losing streaks before his edge could play out? How do you ensure you can survive the volatility long enough to win? That requires understanding our next core concept, the law of large numbers. And we'll break that down in the next video on the Quant Street.
And that's it for this one. Thanks so much for watching. If you enjoyed the video, please give it a like and subscribe for more. I'll see you in the next one.